Let's just talk about this market because we've seen aggressive repricing. We've heard from Scott Maynard said that the repricing going on in the bond markets has been vicious, aggressive, and perhaps overdone. Can I get your take on this pricing in the markets? The markets are now pushing for 2 rate cuts by the end of the year.
No, that's exactly right. And I think you need to put it in context, though, which is that we've had a huge rally since January, which has led to credit conditions being some of the best that we've seen for years, even without any quantitative easing. So I think what you're seeing now is really actually just a natural reaction to that extreme tightening, as investors are a lot more cautious about what's going to happen in either the trade war rhetoric or in the global economy in the second half of the year.
What does this all mean for the primary markets and debt issuance, Henrik?
So I think in short, it means that the fantastic issuer conditions that we've had are going to be a lot more difficult in the second half. And I think investors now really want to be paid to invest. So unlike back in April, where every deal just went out the door as soon as you posted on screens, now investors are asking for much more of a premium in order to come into a primary bond transaction.
Well, let's just talk about the risk and the premiums, Henrik. I want you to take a listen to this. This is the CIO from PIMCO, Dan Avassen, and we caught up with him last week, and he's warning on credit risk. Take a listen.
There's froth, across different areas of the market, but by far the area of most concern for us here at PIMCO is in the credit markets, and specifically relating to corporate credit risk. That's an area where, we've had about a decade now of very low yields, and an area where we're getting, a lot more concerned about fundamentals.
So they're concerned about fundamentals. Are you?
That's actually that's a great quote you put on it. It's very topical. It's how a lot of investors are thinking about the market. So what drives the market is really technical, supply and demand, and obviously the underlying credit fundamentals. So the reason why you've seen the sell-off now is that investors, by and large, are worried that a global recession could come as a result of the trade rhetoric. And therefore, that would undermine the economic fundamentals and cause corporate credit to struggle. Particularly something that's been highlighted is the BBB category of low investment grade. I have to say, though, that so far in results, we're not seeing that. Clearly, there's a lag effect of potential tariffs and so on. So you could start seeing it come in by the end of the year. But right now, I think what's driving markets is technicals rather than any sort of concerns around fundamentals, with one exception, which is on the high yield side, where we've seen a decompression. So single B, riskier companies, there you've seen more of a dramatic sell-off. And that's clearly where the first signs of a fundamental recession would be.
Okay, interesting. So you're talking there about differentiation that you're starting to see in IG and high yield. What about differentiation between the US and European markets? Because the gap between European and US credit spreads has been narrowing a little bit. What are you seeing in terms of what investors are saying and doing in these two different markets?
So clearly the gap was driven to a large extent by ECB QE in most of last year, and that has been causing the spreads to narrow. I think now people view the two economies as relatively similar in terms of risks. Obviously, the Fed has much more room to cut rates and stimulate the economy. The ECB has less policy room because the rates here are very low already. Generally, we're seeing a preference from investors for euros, and that's to do with the relative swap rates that they're able to get in their home currency. So we continue to see a lot of demand for investment-grade euros in particular. While I said they're worried about fundamentals and wanting to get paid for the risk, the markets are functioning and they're open for issuers at the right price.